Ben, another fascinating year so far for technology stocks and equities more broadly. We've seen Trump's Liberation Day tariffs, sharp fall, and then a very sharp recovery, already back to all-time highs again on the Nasdaq. What's driven the market, and are you now concerned at all about valuations? Probably a question I've asked many times before.
Well, it has been a very eventful year, to say the least. We started obviously with excitement post-Trump's second victory. We then were met with an unexpected Chinese AI model that took down MySpace, and then the broader equity market suffering from Liberation Day and fear really around what a reset in global trade might mean. And of course, since then, and sort of points of maximum fear as measured by a whole bunch of different indicators, we have, as you say, gone back to highs. We really ground higher, as many of those worst case outcomes didn't transpire. Again, there's still lots of uncertainty out there. We don't know how many of these trade deals are ultimately going to fall, but it does feel like this idea of a recalibration rather than a reset is now the base case. And against that backdrop, we've seen corporates continue to do well. We've seen tech leadership reassert itself, because ultimately AI data points, capital spending, AI adoption and so on have really been very positive, and that's really what's driven markets back to highs. In terms of valuations, look, we started the year at sort of elevated relative to history levels and then moved a little higher, then sold off pretty sharply. As it relates to tech, I think we're trading towards the higher end of where valuations have traded post the great financial crisis, and I think that naturally gives people some pause. It's always easier in theory, at least, to buy things when they look cheap and harder to buy them when they look less cheap. But the reality is that when they look cheap, and I put that in inverted commas, it was during this tumultuous period in April where we were worrying about what GDP would look like and what earnings would look like. So, I think what I would say about valuations is that, well, frankly, it's never easy, and that throughout my career, the number one pushback to owning tech has typically been around valuation. And look, we're not being flippant about it. I think what we're excited about is technology earnings, at least in the areas that we're excited by, have been moving upward to the right, upwardly revised. The valuation starting point is, not unreasonable, is how I'd characterize it, against a backdrop of rapid AI adoption, a historic infrastructure build, and the potential for new general purpose technology.
Okay, now a challenge for you as an active manager has clearly been market concentration in the recent period. Have you seen any change in the environment? Are we seeing any broadening out of the market?
Yeah, as an active manager, you're quite right. The market has been incredibly narrow. That's made for a difficult backdrop for nearly all active managers, certainly in the growth world, because Mag 7 or any other select group of companies has really been driving returns. Now, just to back up, they've also been in the engine room of the absolute returns that we've been able to deliver for our shareholders. You have to be careful what you wish for, and we've been right broadly around this idea that natural monopolies such as Apple and Google, while maybe their highest growth rates are behind them, they've actually been incredible vehicles for shareholders to invest with. They've also been a thorn in our side as it relates to being able to deliver alpha relative to the benchmark, because they've dominated returns, because they've dominated industry profits. As I think going forward, how do we feel? We feel that the market will broaden, that we feel that we're 2 to 3 years into a new technology cycle. History, at least as a guide, suggests that winners from prior cycles fare less well in subsequent cycles. Of course, all of those companies are well aware of that. Their R&D budgets are demonstrative of their desire to remain relevant. Who is one of the leading frontier AI companies in the world? Google is. So does Google have risk associated with AI? It does, but it also understands that risk. So these companies are not going to go quietly, but I do feel that history as a guide suggests a broader market is highly likely. And then finally, I'd say that, again, I and Nick and many of the other members of the team, we're now a team of 11, we've got multi-cycle experience. One of the things that investors typically don't talk about, because we tend to focus on our winners and people want to hear, when did you first buy Google, or when did you first buy Apple, but they rarely ask you, when did you last own a stock that is no longer relevant. And I think that's a core skill that we've developed. It's a core part of our investment process, and it hasn't really been a helpful sort of tool, I suppose, over the last few years as those mega caps have dominated proceedings. But if we're right, and if AI starts to act as a potential a magnet or as a way to redistribute profit pools, then the skills that we learned and honed over prior cycles should start to become really quite relevant again.
Okay, now you've obviously been very bullish on AI. You've called yourselves AI maximalists. There are skeptics, you've said that already. What if you're wrong? What are the downsides or the risks of it not working? Or are we already past the point of no return now?
Well, that's a good question. But are we past the point of no return? I suspect we probably are, in that the model performances that we're seeing from the very latest Grok 4s, but also Anthropic and OpenAI models, and obviously Gemini from Google, the capabilities of these models are already at levels that we think make some of the bull case an inevitability in terms of the ability for AI to not just act as a tool for humans, but to begin to sort of replace or supplant some of the stuff that today is done by humans. And it sounds very scary, I suppose, but it's also hugely exciting about what humankind can do if we're able to gravitate to higher value work, like we've done in various other periods of time where technology has automated human tasks. It's becoming increasingly obvious that AI is going to change the world that we know. That doesn't mean, however, that this investment story is done and dusted. There are meaningful risks to the AI story that exists today. Again, that may sound counterintuitive if you're an AI maximalist. Why are you talking about risks? Partly because that's our job, to remind investors that things don't go up in a straight line even when you're right. The principal risk that we see today isn't a Chinese entry or a new model or some piece of regulation that could potentially slow some of the trends we're seeing. It's really, can AI models continue to progress? If they can continue to move and scale in the way that they have been, then the weaknesses of some of those models get lost very quickly. And the rate that we're scaling is sort of unprecedented, vastly faster than we saw with chip scaling and Moore's Law. The scaling that we're seeing today is why new models that are coming out in increasingly short spaces of time are meaningfully better. So Grok 4 from XAI is meaningfully better than Grok 3. Which isn't a very old model in itself. And we're going to see new frontier models from Google and from OpenAI and Anthropic and others. And as we continue to scale AI, the addressable market for AI, of course, opens up like the road would open up, with a fast performing car. So the biggest risk is that at some point that scaling slows. So again, can't dismiss it entirely. And at some point that must be true. But Grok 4, very recently produced, suggests to us at least that scaling laws today are alive and well.
Now, a feature of the investment trust vehicle that you manage is that you have 5-yearly continuation votes. Now, you're quite self-critical. How would you look back on the past 5 years for the trust and for technology? And again, how do you look forward, more importantly? And what do you say to shareholders looking to vote?
Well, first, it would say to shareholders, we'd love another 5 years to be part of this incredible tech story that's evolving. And it's been the privilege of my life to be, to have been involved in tech investing for as long as I have, but also to be, the manager of what has been an incredible investment vehicle, Peller Capital Technologies. So, if you can vote and you're so inclined, we'd love to have your, continuing support. Your question around how do we feel about the last 5 years? Well, look, it's been an incredible period, hasn't it? I mean, we caught a global pandemic, the ups and downs of that, and it was very much a whipsaw period for technology companies. And I think in hindsight, it was sort of the zenith of the last kind of cloud software as a service technology cycle. And then we came through that, we've come out of the pandemic, and it was a pretty tricky period initially for valuations and for some of the, I suppose, hopes that the pandemic behaviors would persist, I think have sort of not transpired. And so that's been a sobering part of the last 5 years. And then, really the last half has been really about the AI story. It's been ChatGPT. We're just, not that far from the 3-year anniversary of what I think is, the Netscape moment for the AI story. And that's been an incredible period. And I think, if you look at the sort of rolling 5 years that as we sit here today, the trust's NAV is up more than 100%. I think you've got to be happy with that. I think that they're fantastic returns. And again, this is no guide to future performance. The 5 years prior to that, the last 5, I think the trust's NAV was up more than 2.5 times. The tech sector has ups and downs, but again, it's been an incredible place to be for me as an individual, as an investor, and I hope our shareholders feel the same way. How do we feel about the next 5 years? Without wanting to really get bogged down in trying to predict outcomes, do we feel as excited about the next 5 as the last 5? We absolutely do. We're 3 years into what's likely to be a multi-year investment cycle in AI. We're beginning to see the adoption of some of the AI engines like ChatGPT from OpenAI, said to be 800 million people now. Like, we're moving into a world of AI going from exciting and emerging, and over the next 5 years we're going to see it in the mainstream. And what that will do is really hard to know. But what we can say from history is that the visible market opportunities that we can invest against today are going to give way to a vastly greater canvas where pricing of AI, where capability of AI, where the billions of people that adopt AI open up market opportunities that didn't previously exist. And I think, how can you not be excited about that?